Welcome to the Real Estate Deep Dive with Paul D. Garrison from JP and Associate Realtors. Thank you for joining us today. I know it's been a little bit since I've done a real estate deep dive, but as they say, life happens. It's been a little chaotic for me, but I'm hoping to get back into a bit of a routine here. Today, we're going to be talking about what's happening with mortgage rates. I'd actually like to start out with this quote from Lawrence Yun, the chief economist for the National Association of Realtors. We were actually fortunate enough to have him do a presentation to our brokerage about a week ago, and this topic got brought up. So in this quote, he says, a return to a normal spread between the government borrowing rate and the home purchase rate will bring the 30-year mortgage rate down to around 6%. So let's take a moment to dissect what he's talking about. So the government borrows money to pay on the deficit, and the rate that it pays interest on that money that it's borrowing is considered the government borrowing rate. Probably the best measure of that is the 10-year Treasury note, or the 10-year Treasury yield. And if you've followed some of my previous deep dives, you've probably heard me mention that how the 30-year fixed mortgage rate tends to follow the 10-year Treasury yield pretty closely. But there's usually a bit of a spread between what the government pays on its borrowing rate, or what the 10-year Treasury yield is, and what the 30-year mortgage rate is. And that spread averages out to about 1.7. So you're probably wondering, well, then why aren't mortgage rates at 5.5%? Well, the problem is right now we're actually seeing kind of an abnormal spread in the market between these rates. We're seeing a spread of around 2.9%. So why is there this larger spread? It's due to high interest rate risk. So during the pandemic and the last housing crisis, investors were afraid to take on risk, and that fear translated into an extra fee to borrow. Today's situation is very different. Well, a recession is kind of out there on the horizon. Few predicted it's going to be a big crash. The pandemic is largely under control. Instead, the problem now is simply that mortgage rates have soared. Its rate volatility is just basically extraordinarily high. So you're probably saying, what does that have to do with spreads? Consider the quirk of the mortgage industry. Your lender promises you a rate weeks before you actually close on the loan. You lock in that rate today, even though you probably won't find a home and close on the loan for another 4 to 6 weeks. That gap creates a conundrum for your lender. If rates plunge in the coming weeks, you'll simply ditch the loan for a better deal. If rates soar, you'll keep the loan, be happy, and you're in a situation that's great for you but not so great for your lender. It's this risk plus the likelihood that these loans are going to be refinanced in the future that are causing this spread to be larger than normal. Which takes us back to the quote from Lawrence Yun. If we see a return to more of a normal spread, then we're going to see rates drop back down to around 6%. So what's going to make us return to a more normal spread? Well, as I mentioned, the interest rate volatility is one of the larger contributing factors. If we look at this graph of what the 10-year Treasury yield has done this year, we see a pretty dramatic climb. If we look at the last couple of weeks, we see a bit of a reprieve from the highs. This was due to some favorable news that indicated that inflation may be getting under control, or it may not be as bad as we thought. Now, I'm not here to tell you that we're through inflation or anything like that, but if we continue to see positive news along these lines and the Fed slows or stops their fast pace of rate increase, it will go a long way towards helping us return to a more normal spread. So along those lines, I wanted to wrap up by sharing with you what a couple of the experts in the industry are saying about this. So here's a quote from Barry Habib from MBS Highway, Mortgage-Backed Securities Highway. Because we see a slowdown, we see inflation comparisons start to become more and more favorable. We start to see that inflation numbers move lower, lower, lower. As a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5 or below 5 within the next 6 months. So again, I will say that this quote's very dependent on what happens with inflation and what we think inflation is going to do. So kind of keep that in the back of your mind as well. Which kind of leads me to this next quote from Bill McBride, the founder of Calculated Risk. He says, "My current view is inflation will ease quicker than the Fed currently expects." So let's hope that he's right. I think it's, again, it just kind of really hits home. A key thing to watch is what the inflation numbers are going to be doing. That's going to really be telling on what mortgage rates are going to do as well. And to kind of wrap things up, I wanted to give you a quote here from Ali Wolf, the chief economist at Zonda. The housing market is expected to face continued uncertainty heading into 2023 as consumers, financial markets, and policymakers work through their respective challenges in today's economy. Again, what she's saying is we're not out of the woods yet. There's still going to be a lot of uncertainty, but hopefully I've given you some of the key indicators to keep an eye on and to watch. And if you have additional questions, please let me know. Many of the metrics and numbers in this presentation are based off of the national real estate market. However, local areas can vary. Please give me a call and we can discuss your situation. Have questions about your specific needs or location? Please contact me at 214-683-8188 or paul@pauldgarrison.com. Want more information about the housing market and related issues? Be sure and check out my blog at www.pauldgarrison.com. Thank you for your time. Please take a moment to visit our website at www.pauldgarrison.com.